Hey, I'm super excited you're here tonight. Thank you for attending. My name is Mark, and I've been a mortgage advisor since 1986. And over the years, credit has always been a potential issue for a lot of my customers. And not only can it prevent someone from getting a home loan, but it also can be an issue with their pricing. And it just recently changed where it's gotten a little bit more expensive. So if you're putting minimum down, which a lot of folks are, and let's say 5%, if you don't have a 780 and better credit score, you're going to pay just a little bit more for your home loan. And it actually, the lower your credit score goes, the more you end up paying. And I want all my customers to get the best mortgage deal possible. And so the way to do that is to help people improve their credit score, ideally to 780 and better if they're coming in with minimum down. And I want to educate the world on how to do that. So please type in the chat a big fat yes if you would like to improve your credit score and if you'd love to have 780 and better yourself. I know that I would. So I'm going to give you my own big fat yes. You can see that there on my phone. Yes, I personally would love to. Anybody else out there? Don't be shy. So today we're going to discuss strategies on how to improve your credit. We're also going to go over some of the details of things that you need to do because that knowledge impacts what you need to do to improve your credit score. During this webinar, please type in the chat your questions. I really want this to be interactive because I want you to get benefit out of this. I see someone.
Yeah, I think we got to think that the chat might be disabled. So hopefully maybe you can get that working while I'm talking. I don't know.
Well, you know what? Obviously the Q&A works. So please type in the Q&A box and we will monitor that. So awesome. Thank you for jumping in with that. And obviously you can do that anonymous. So I want you to ask your questions. You can do it anonymously if you prefer, but I really want you to interact and get as much value out of this webinar. This is for you today. We're going to monitor it, answer all your questions. If there's something we don't know, we'll get back to you afterwards by email. But I've got an expert here, so I think that your questions are going to get answered today. At the end of this webinar, I'm going to make an offer to you on how you can work with us further if you'd like. So I want to introduce our featured speaker, which is Sarah Perkins. She's an expert debt negotiator with Blue Water Credit Repair. And her company has literally helped thousands of people over the years, as well as a good number of my customers improve their credit. They've been in business since 2008. So everyone, please welcome Sarah Perkins.
Thank you, Mark. Well, welcome everybody. I'm glad you guys are taking some time out of your day to join us. And really, I just hope to instill some credit knowledge, maybe answer some questions, and really equip you to have the best credit score possible. And if there's any issues that you can't do on your own, well, at the end, I will show how our services could possibly help you. So before I get into it, just a little bit, like Mark said, I work for Blue Water Credit. I've actually been in the credit and debt industry for over 20 years. So I feel like I'm a little bit of an expert in this field. And so that's a little bit of my background of where I come from. And let's get going. So I really like to start with this question because I get it all the time, because who doesn't have Credit Karma on their phone? But I always hear people go, Sarah, my Credit Karma score shows 680. Why is my loan officer showing that I have something different? And so I kind of want to break down a little bit about how a credit score works, the differences between, the different brands and versions out there. So the simplest way to describe credit scoring models like Credit Karma is we have different brands of credit scores, and within those brands, we have different versions. So Credit Karma actually comes from our Vantage score. So there's two main credit score brands in our world. There's a few other small ones out there, but the main ones that are used are going to be your FICO and your Vantage score. So Credit Karma pulls from a Vantage score, or probably most of your credit cards, car loans, mortgages are going to pull from some form of a FICO score. So I like to show, well, why is there a difference between the two scores? And, real simple, you can kind of see on this pie chart that each different brand weighs different categories differently. So, just right off the bat, payment history on a Vantage, 32% of your score, payment history on a FICO score, 35%. So just even that small percentage difference can, create a difference in your credit score that between the two different brands. And then with FICO, I mentioned FICO is probably the most widely used scoring model. You can see there are many different versions. There's actually 21 versions out there to be exact, and you can kind of see a bunch of them here. So, you got everything from your bank card score, autos, and all your different numbers that you see here. So, if you're looking at a certain FICO score, it's going to even vary between the different versions that you see here. And the way I like to show this this is a single person pulled their credit, and we pulled their FICO and their Vantage and all the different brands and versions. You can see here how different they are on the same day for the same person. So across the FICO, you can see there's an auto, a bank card, a mortgage, and then just a general FICO score. Then you have your Vantage score. And then you have the different credit or consumer credit reporting agencies like Equifax, TransUnion, Experian. I mean, look, just in Equifax and TransUnion alone, when you look at the low to high difference, there's a difference of 58, 72, and 54 points. I mean, that's a huge variation just between the different versions and the different brands that I talked about there.
So I'm going to jump in. As a loan officer, I often have folks tell me, hey, I've got a Credit Karma of such and so. And I've seen when I run the credit, it can be either 30 to 50 points higher is what their actual score is, or 30 to 50 points lower. And it's often a surprise. And I don't want to get overly, detailed about it for my customers. They're like, Credit Karma is a great thing because it gives you an idea what's going on with your credit. And what's most important is we look at the trajectory. Is it getting worse or is it getting better? And then when you get to a loan officer such as myself, I currently have a way that I can do a 3-bureau soft pull. So I'm not going to affect your score at all. See what your scores actually are. And then if we need to work with you to improve your credit, and you could be watching your Credit Karma and go, oh, okay, I'm getting better. Not a exact one-to-one correlation, but it gives us a really good idea of what your trajectory is.
Yeah, absolutely. And I actually even recommend it to our clients that are tracking to see how balances are changing or if a new collection pops up. So it definitely is good for, the meat of the information that they provide. But as far as a scoring model, can be very different. Or I'll hear people even say, my bank sends me out something every month that I can get, my credit score for free. And a lot of times I like to tell people, well, that's probably your FICO 8 model. FICO 8 is probably the most widely used one on banks or other kind of apps where our mortgage is completely different from the FICO 8. So a little think of how a credit score is actually made up. We have a nice little pie chart here, but there are 5 different categories that we have. So the biggest category that is going to drive someone's credit score is payment history or delinquent accounts. So that accounts for 35% of your score. So if you have late payments, collections, charge-offs, bankruptcies, those things are going to tank your score tremendously. And I'll have another slide that shows exactly how much it can affect it point-wise, but it's one of the biggest components, and it's what we work on at Blue Water Credit to help resolve. The next biggest component is your credit card balances / utilization. So we're not necessarily looking about how much debt you're carrying, but we're looking at what your balances are in relation to the limits that you have. So if you have a $10,000 card and you have $5,000, spent on it, you're at a 50% utilization rate. So what FICO likes to see is something that is right between 1 and 10%. So not necessarily paid off, but you want to show some kind of balance, but ideally keep it below 10% if you want to earn the maximum amount of points within that category there.
And I want to jump in because a lot of times, if you're a lay person and not used to this, you get your statement, you pay your card down, and then, maybe you run up again, and then you get your statement again and you pay it down, and you're like, why is my credit score not improving? And do you want to answer that, Sarah? And
Sure.
what the best practice is?
Yeah, it's one of those mini credit games that we have to play out there, unfortunately. So yeah, I hear it all the time. Hey, Sarah, I pay my balances off every month. So why, when you pull my credit, does it show that balance that I just paid off? And what I like to tell people is what the credit cards are reporting to the bureaus are going to be what the balance is on your statement. So if you take a statement and you look at it and look at that statement closing date and the date that that statement was created, that is the balance that gets reported to your creditors. So if you want to play the game of getting the balances down between 1 and 10%, we usually like to advise paying the credit card down or off at least several days before that statement date is coming out. So it's going to require you logging in, kind of seeing what your current balance is, timing and knowing when that statement's going to come out, and playing the game of getting that payment in and clearing before the statement comes out. So like I said, that's usually 2 to 4 days prior to the statement date is what you want to shoot for.
Yeah, and then if you do that, some people have a lot of debt and they're not quite down to that 10%, but as you're working your way down towards it, and especially for those people that are simply looking to bolster their credit and maybe they don't have a ton of debt on their card, it's best that they don't necessarily pay it off. They keep a small balance, but you want to pay that 2 to 4 days before your statement date and make sure that it clears. So the important part is it's clearing 2 to 4 days before your statement date. Let the statement come out. And then if you need to run your card up a little bit to create activity on there, do it. And then the next month, pay it 2 to 4 days, such that it clears at that time.
Yep, absolutely. And then going over real quickly, the rest of the pie chart that makes up your credit score. The next one is going to be the age of your credit. So older the account is, that when they average the date that your account was open is the better. So we want older accounts. They're going to help boost up your score, the older accounts that you have. They also want to see a good mix of credit. So we're talking, 1 to maybe 5 credit cards open max, maybe 1 installment loan, something like an auto loan or a student loan is going to be something that's qualified as an installment loan, and then 1 mortgage. So ideally, that's what FICO likes to see to earn the maximum amount of points within that 10% pie chart right there. And then last is credit inquiries or new credit that you open up. So we'll go over inquiries a little bit later, but applying for a loan, when you have an inquiry, each inquiry can affect your score 5 points up to a max of 20 points there. And when you're on the edge, that 20 points can play a big role in the rate that you get.
So another key takeaway on what we just went over, can you go back to that slide just for a minute?
Oh, yeah.
Is the open accounts. I have a lot of consumers, or average age of credit accounts, I'm sorry. I have a lot of consumers that think they need to close out their accounts, and they close out their older accounts and then their score goes down. If you have credit with good history, you might have them zero balance. It's not necessarily a good idea to close those accounts. That's a key takeaway. And then of course, on the open accounts, they're looking for a diversity. A lot of folks may not yet have a home mortgage. It's not the end of the world. You can still have great credit without a home loan, but having a few revolving credit cards and installment loans would be great.
Yep. And just to show you, we talked earlier on the last slide about, 35% of your score is determined by your payment history or delinquency. So I like to throw this out as an example. Say you have someone that with a 740 FICO score, look, 130-day late can drop your score anywhere from 40 to 110 points. So, I mean, that's huge for just one late on one card. And then you can kind of go down, 90 days late up to 135 points, having foreclosures, bankruptcy, all those kind of delinquency or derogatory accounts. You can see how big of an impact it can have on your score. And the higher the score that you are starting with, usually it's going to have more of an impact. The lower your score is, you probably already have some of those things. So not every time that you get a 30-day late is it going to knock it down 110 points. Each account maybe will bring it down a little bit more and a little bit more with the more derogatory accounts that you have there.
And it is true that over time, as those lates go off into the distance, meaning older than 12 months, older than 24 months, it has less and less impact on your score, correct?
Yes, that is true.
So here's a question that we have, Sarah. How long do charged off accounts stay in your history / impact your credit score?
So with any account, they can stay on a credit report for 7 years. So 7 years is that number for a charge off account, a closed account. And usually they're going to go off of that last payment date as far as determining when that 7-year period starts. So
and how long do you think it's really impacting their credit score?
It's probably going to have the most impact the first 24 months. There is a new FICO scoring model called the 10T. And we say it's looking at trending data. So they're putting more weight on your credit history in the last 2 years. We don't really know how much, but FICO definitely is weighing stuff within the last 2 years a lot more heavily than things past 2 years old. So, so if you are curious about where do I actually even know what my mortgage FICO score is, we talked about Credit Karma not being accurate. I talked about, your banks or whoever, credit monitoring systems giving you scores. Besides having your lender pull it, like Mark said, he's able to do a soft pull, which does not affect your credit, but a lot of lenders don't have that ability and can do a hard pull, which can affect your credit with an inquiry. As a consumer, you can go to myfico.com. They either have an option for a subscription service of $29.95 a month, or you can do a one-time soft pull of all 3 bureaus for $59.95. It's going to give you a very extensive report. When I showed you all those 21 versions of FICO earlier, basically it's going to give you a score in each one of those versions, and one of those versions on there is going to say mortgage. And so if you're really wanting to know where you stand as far as your mortgage score, what a lender is going to be looking at, and you don't want a lender to necessarily pull it yet, this does not hurt your credit because you are pulling it yourself. So myfico.com is a good resource and one of the only resources where you can get your mortgage score without having a lender pull it.
Yep. And you have a lender right here. It's no cost to you, and we don't hit your credit score. So, I hope I can become your lender. Give me a call, pretty please.
Yeah.
We do have a question.
Yep.
Is it better to settle a closed account or pay it off in full?
So I'm assuming by closed account, if there's a balance, most likely it's a charged off account is what I believe you're referring to. So once it hits a point of charge off, and charge off simply means you've gone over 180 days past due, and now that bank or creditor has written your debt off, which allows them to sell it, take a loss on their taxes. At that point, settling or paying in full is going to have the same effect on your score. It's going to zero out that balance. So personally, I would want to save the most amount of money. So why pay a $5,000 debt if they are willing to settle for $2,500? And that's where kind of my expertise comes in. And I can kind of go over, I have a slide later talking about, when you should actually settle account, which accounts that we recommend settling, either for increasing your score, or sometime as a lender, maybe Mark can attest to this, that certain accounts need to be paid off. It necessarily doesn't, it's not a score thing, but underwriting may require that if it's over a certain balance, that it has to be taken care of.
Yeah, so this is really important when you're working with lender and credit scores and all that sort of stuff. If we're working on a home loan, often a charge off, we don't necessarily have to have that paid off. So if we're able to accomplish our goal with the credit scores that we do have, I may say, hey, hold on to your money. Let's not pay this charge off. It actually comes down to a judgment call on the underwriting. And a lot of times I got a transaction through where we had a $20,000 charge off and we did not have to pay that off. And the person was able to get their loan, and it made a huge difference because they really didn't have that 20 grand, and it would have impacted their ability to come up with down payment and closing costs. So on something like that, you need to consult with the team, and that's why we're here to work together. And there was something else I was going to allude to. Another question has to do with collections. Collections are a bit different. And there again, are we trying to accomplish score issues, or are we trying to accomplish underwriting issues for that loan? And often with collections, if they're over a certain amount, like $1,000, and it's not medical, if we're over $1,000 in total collections, we have to do something called a manual underwrite, which is much stricter in the qualifying process. So in many cases, I'm going to say, hey, we want to get the collections resolved. And that's a lot to take in. So reach out to the professionals. We're here to help you.
You want me to, I'm going to answer one more question. It looks like we thrown in there, and then I'll have you take the next slide there, Mark. But if you don't use a card and they close it because you're not using it, is it bad for your credit? So where that comes into play, not necessarily you're getting dinged because, hey, they decided to close your account. Where it's hurting you is that average time that your cards have been open. So if it's a card that has been open for 10 years and you haven't used it, then all of a sudden it gets closed down and your next oldest card is like only 3 years old. Now you've lost that 10-year-old card that was giving you a higher average time that your cards were open. So it's happened to me where I've just kind of forgotten to use a card, and sure enough, especially during COVID, we saw it happen a lot. I think the banks got a little bit nervous. They knew income wasn't coming in, people didn't have jobs. And so they were, being very aggressive in closing accounts or lowering your credit limit, which then hurts your utilization just because they didn't want to extend themselves and, have someone not be able to pay if they used it. So that's why we say every 6 months, you want to try to use those cards that maybe you don't necessarily always use, but they are older and they're helping you out with your credit age.
So this next slide I'm sharing with you, the cost of lower credit scores based on a purchase price of $500,000 with a 5% down payment on a conventional loan. So you're going to see here, if you're coming in with 5% down and you've got a 780 or better credit score, the first year doesn't cost you anything extra, and ongoing years, nothing extra. But if you're between 760 and 779, you're going to pay an additional $1,330 in the first year. And then for each year forward, it's an extra $142.50, approximately 10 years, because that's your mortgage insurance cost. You know what? For most people, that's not that big a deal. But as you roll on down to the lower credit scores, and I'll take us down to the bucket between 620 and 639, that first year cost is $15,627. And then each year thereafter, you're paying an additional $6,127. Ouch. That's a lot.
I don't know about you. I don't have that extra money. I'd rather have that in the bank.
Yeah, even if, in some cases, if your score's that low, we may not be able to get you a loan. But if we are, that's the additional cost you're looking at. So that's why we want to get your credit up. Here's some minimum credit score requirements by loan products. So conventional loans, generally 620. FHA, standard goes down to 580. FHA with a 10% down payment can get all the way down there to 500. VA with a loan amount less than 750 is 580. USDA 580. First-time buyer programs. I get this one all the time. The best first-time buyer program, in my opinion, is the state of California, Cal HFA, and that score is 640 if it's an FHA based product. If it's a conventional based product, it's 680. And if you fall into the category of low income, or 80% of the area median income just been raised to 91,120, then it's a little bit lower, 660 on the minimum score. If you are in the jumbo category, which is a loan amount of, let's say, 764 and above, most of those are going to require a 680 and better credit score.
Thank you,
Roll
Mark.
on.
So we good on questions there? Okay, perfect. So I'd like to go over some big mistakes you guys want to make sure that you stay away from. This is going to definitely help preserve what credit score that you have. Number one is setting up auto payment and not checking it each month. We just had a client that signed up with us because instead of paying the minimum due balance, they set it on a certain dollar amount. They said, I'm going to pay $100 a month. Well, they didn't realize that they were charged some kind of fee or the balance went up, and all of a sudden what they were paying was not enough to carry or cover the minimum amount due. So, you think your payments are coming out on time, and then only to find out you're not paying enough. And then you're going to get those 30-day late, 60-day late. So you want to make sure that you're checking in on your auto payment. I usually suggest always having it set to at least whatever the minimum is. And if you have it set on a dollar amount, making sure that you check that each month to make sure that is covering the minimum amount too. Number two.
I'll just interject there.
Yeah.
I realize it's a pain in the butt to have to check, but it's, I think, much more a bigger pain in the butt because I've seen a lot of people fall in this category to maybe not get your loan or have to pay an additional $15,000 for the first year and $6,100 thereafter because this messed up your credit. And it does happen, and I don't wish that on anyone.
Yep. And Mark, I don't know if you want to answer real quick. We had a question. Low income. Do you know what the income guidelines are right now for what is considered low income? I guess at least in this area.
It's 91,120 for Sacramento and Placer counties and El Dorado County.
And that's for a single person or household?
Household.
Household. Okay, perfect. Yeah, number two is just maxing out your credit card. So one maxed out credit card can drop your score by 40 points. So, running, even though you have that credit line there and it's available $5,000 doesn't mean you necessarily should be maxing it out, especially if you're trying to pay attention to your credit score. And multiple maxed out cards can, drop your score by more than 100 points. We kind of mentioned earlier, closing a credit card, whether you do it yourself or the bank does it because you're not using your cards, your age of credit is definitely going to go down. So that is going to hurt your score. So making sure that you're staying, active with your cards. I have a First Premier. It's a pain in the butt because I have to pay a $6, I think, monthly fee on it just to make a payment. But you know what? It's been open for like 20 years, and paying that $6 a month to me is worth having that card open that's had a perfect payment history for over 20 years. Next is annual fee causing missed payments. So I mentioned with the auto payment, but you have a card that you never use. Maybe you get statements in the mail. You're used to it always saying zero, you throw it away and then you don't open it, only to find out that, hey, they charged you that $99 for that annual fee and you didn't pay it just because you didn't realize it because you weren't using the card. So, making sure even when you get your statements in, making sure nothing has been added on, with a card that has an annual fee. We talked earlier about whatever shows on your credit card statement is what's going to show on your credit report. And a little trick, and I'm going to go into more detail on this, is if you have limited funds, paying down your smallest balance limit card first to help with those maxed out cards there. Let's see. And
So the idea behind paying down the smallest balance first is you work on the snowball effect, right? Once it's all about cash flow in financing. So you want to free up your cash flow, pay off the small bill first, and then go on to the next bill. And I'm just going to add in here, and I apologize if it takes a little bit more time, But on the auto payments, I understand the ease of use and wanting to use technology, but you're talking to a person who, grew up when I was 19. My mom sat me down and said, son, if you could take over all these bills, all the family bills, I can spend more time doing things I need to do for the family. So she sat me down with a little filing system. She'd been audited about 3 to 4 times because the IRS couldn't figure out how she was able to accomplish what she had. A single parent with kids, properties, wasn't easy. But what I learned in doing the filing system, first off, she was paying late fees on everything. And it wasn't to the point of being reported, but we still paid late fees. And back in those days, it totaled about $300 a month, which in today's dollars is probably like $900 to $1,000 a month. And all I needed to do was pay that bill by the first so that we didn't incur a late fee. And so having a filing system, I've got one for each bill, right? Create a little filing cabinet, put your little Pendaflex in there, and let's say it's the water bill, and I've got the month of January. February comes along, it gets clipped, and February's on top, and March, and then April, and then May. And I do that for all my bills. That way, if you get audited, you can like, boom, there's all my bills for the last 12 months. And I actually keep those for a minimum of 3 to 7 years. And what that does is it trains you, right, on what's going on with your finances. You're not going to end up being late if you get a system like that in place and you get that diligent habit. And then additionally, what it trained me is knowing what those bills are. I learned how to get out of debt using that snowball system. So at one point, I've had a duplex loan, I had a commercial property loan, I had a home loan, I had car payments, etc. And I learned like, okay, this is the smallest balance. Boom, that's gone. I got extra cash flow. And I worked my way all the way up to where today I'm out of debt. And you can do the same thing too, but you got to develop great habits.
Thanks, Mark. That's an amazing story there. So moving on to what are some tips or steps to increase your score by 50 points? Who doesn't want their score up a little bit higher? And here's some easy things that you guys can do without the help of Blue Water Credit. So we talked about paying down credit cards. So utilization, second biggest category in a credit score. So we talked 1 to 10% of the limit, one maxed out card, 40 points it can drop you, multiple maxed out cards, 100 points. And like we mentioned before, if you're limited on funds, a maxed out $5,000 card is going to hurt you just as bad as a maxed out $500 card. So why not take care of that $500 one, get the jump of points on that and work your way up, like Mark says, as you have funds available. Another tip would be getting added as a authorized user on a card. So we have people that come to us all the time that have little or no credit. And so a good way to gain credit without having to wait to have your accounts age is having yourself put onto somebody else's credit card. It can be mom and dad. It can be, a significant other. I actually even did it for a friend, but we found, an older card because, his average length that his cards were open was like 3 years. So we found a card that I had open for 20 years, add him as an authorized user. All of a sudden he got boost from being able to borrow the credit history from that specific account onto his credit report. So it's like he had, magically this account for 20 years, even though we just added it on it, the month before. But in the same aspect, if you're an authorized user on the card and that person, racks up the bill and has some late payments, it's going to hurt your credit as well. So you want to make sure if you are an authorized user on a card and it is maxed out or there is some bad payment history, have yourself removed. It's usually a pretty easy process of calling that creditor and having yourself removed. And it usually takes about 30 days or so to update on your credit report. Also, another way is opening an account. So if you don't have enough credit or you don't have any credit at all, you can't get added as an authorized user, a good option is opening a secured credit card. A secured credit card, it doesn't have to be a huge limit because typically what you do is If it's a $250 limit card, you pay that $250 as a deposit, charge $25 worth of something on it each month, and then go ahead and pay it off. We have a link that we can share later when we get to the end of a secured credit card, 99% approval rate, and it reports to your credit report within 7 to 10 business days, which is super fast in the credit world. Other option we also have for our clients is something called a credit builder loan. So we mentioned earlier about having an installment loan on your account. So not everybody has, a school loan or a car loan. So we have this cool product where you are basically paying $15 minimum. It goes into a savings account, but it gets reported as an installment loan on your credit report. And then after you've been paying into it for a year, you have the option to then withdraw those funds. So not only are you kind of creating a savings account that maybe you could use for when you go to purchase a home, for closing costs, whatever it may be, you're also gaining an installment loan on your account. So you're getting a good mix of credit to help bump up that credit score. And last is we're always available to do a credit consultation for you or your significant other and kind of go over specific things that maybe would help you. That is just not something general that I mentioned up here. Credit inquiries. So we get a lot of questions about, how does a credit inquiry hurt me? Which ones actually go against me? So there's 3 different categories of credit inquiries. You have the soft one, which has no effect on your score. So that's when you pull your own credit. Like I mentioned, going to that myfico.com, annualcreditreport.com, those kind of things. If you are pulling it for yourself only, that is not going to have any effect on your credit score. If you're going through a background check for an employer, those kind of credit inquiries are not going to hurt you. Or if you have an established relationship, say with Bank of America already, and they go to pull it because maybe they want to make an offer to you for another card or balance transfer, those kind of special offers. So if you already have a relationship with that creditor and they're pulling it to extend an offer to you, those aren't going to hurt you. That's a soft inquiry. The next one is promotional inquiries. So those are all those ones that you get in the mail soliciting you for, new cards. Those do not hurt you. So I'll show you how you can opt out of those later with opt-out pre-screen. But the promotional ones, when they pull it because you're not initiating that pull, those are not going to hurt your credit score. So the ones that are going to affect you are what we call the hard inquiry. It can affect your score up to 5 points, typically for a maximum of 20 points. Those are going to be when you're applying for a home, car, credit card, or any kind of loan. And another question we get all the time is about, rate shopping is what they call it. So if you are shopping for, a home with a lender or for a car, if you are having the same type of lender for those reasons pull your credit within a 30-day period, it's only going to count as one inquiry. It's not going to count as multiple inquiries. So some scoring models, you have only 15 days, some scoring models, 45 days. But when we're talking about the mortgage score, because I'm figuring most of people on here, interested in purchasing a home, you typically have a 30-day window to shop. And although your credit report may list 24 months of credit inquiries, only the last 12 months are going to have an effect on your credit. And next is, we get people all the time too. I have no credit score. My lender went to pull my credit and there's nothing there. Well, FICO does have some minimum requirements to be able to create a credit score. So number one is you have to have an account open for at least 6 months. So if you're brand new to the credit world and you go and get that first secured card and you're wondering, well, why don't I have a score yet? It's because you have to have it for 6 months. This is where getting added as an authorized user comes into play, where then all of a sudden it will generate a score because you're borrowing from someone's credit history that hopefully is a card that is older than 6 months. Another thing that can happen is you have cards, but say you haven't used them for the last 6 months. So you paid everything off. You thought you were doing great. Put them in the freezer, cut them up, do whatever, and all of a sudden your credit score goes away. So that's why it's super important to make sure that you are using your cards or using at least one card, some kind of history on your credit within the past 6 months. Last one is there's no indication that you're deceased. So we run into this a lot when we have junior and senior, maybe senior passed away, but stuff is all commingled on the credit report because they share name and addresses. So if they think that you are deceased, then all of a sudden that can create no credit score. So then everybody also wants to know, well, how do I get the coveted 850? So I don't know if you guys know that the credit scores range from a low of 300 all the way to 850. So in the FICO world, there's 550 points possible out there to earn for your credit score. And so we went through this extensive system to kind of figure out what are the sweet spots for each of these categories and how much it can affect your score. So, I'll just go through some of these quickly, but how many credit cards you have, that can play anywhere from 0 to 30 points for your score. And ideally FICO likes 2 to 4. They think that is the best number of credit cards to have. Oldest credit card, older better. They like to see something in excess of 20 years. And same with a loan, that could be a mortgage. So if you have older accounts, that's definitely, you can see between the credit cards and a loan, that's 70 points that you can earn right there. Inquiries we talked about, that can affect your score up to 20 points, 1 to 5 points per inquiry. New accounts. So, FICO does not want to see a bunch of brand new accounts. So once you kind of get past that 6 month, they're not going to consider it, brand new anymore. So when you go out and apply for a new card, that can drop your score by 10 points. Number of accounts with balances 0 to 4. Total balances excluding your mortgage, they like to see balances under 1,000, and that's for all your credit cards total. But you can see that plays only about a 15-point difference in your score. Again, payment history, you can see 175 points is what you can earn or lose in that category. So those are your derogatory accounts, paying late. They're going to base it off of, is it a 30-day late? Is it a 60-day late? And how old those lates? Was it last year? Was it 6 months ago? Was it 5 years ago? So all of those things come into play of how that affects that payment history score.
Hey, Sarah.
Yeah, go ahead.
If someone has late pays, is that something you can potentially assist someone with getting them removed from their credit?
Yes, I would say that is, kind of one of our sweet spots of things that we can open a active investigation with the bureaus and have those kind of things removed. We also, and I'll talk about in a little bit, we have a consumer advocate service where actually we are having attorney partners at no extra cost to our clients, getting those debts waived on some of those that have late payments, deleted from their credit report, and even a cash award back to our clients, which is super cool. Next is past due accounts. So if you have an account that's sitting there past due, you want to make sure you bring those current. Credit card utilization up to 100 points. So under, actually it should say 1 to 10% of the limit is best. And then if you have any bankruptcies, collections, or repos, 80. So if you add up all those points, that's your 550 possible points that can take you from a 300 to a 850. And let's see, do we have any other questions? All right, perfect. So I'm going to go over some updates that recently happened in the credit world that can hopefully help you out there. Here. One thing that's really neat is when COVID hit, that annualcreditreport.com, where you used to only get one credit report a year from each of the credit bureaus, they actually changed that to you're able to pull one each week. And again, that's a soft pull. You're pulling it yourself. So if you really want to really track your credit, see how the balances are being affected, or if you're waiting for something to fall off, you can actually pull a credit report every week through the rest of 2023. The neat thing about this report is it will show you the date that delinquency is scheduled to fall off your credit. So if you're wondering like, well, I think this thing is close to 7 years old, it will say on there, this is scheduled to come off your credit report on this month of this year. The only downside of this report is there are no scores given. So this is just simply the information with your creditors, balances, and all that. So it has no score. Medical collections has been a hot topic. Actually, it started in 2022. They made a huge change where paid medical collections are removed now automatically off of people's credit reports. So it used to be before, if you paid it, it would sit there zero balance. It would still hurt you because it was a collection account. Well, they changed it. They felt like this was unfair to some of the underserved population. And they made the change that when a medical collection was paid, within usually about 30 to 45 days, the bureaus will automatically remove it. And then just starting just recently this month, actually, I think it actually started a couple months ago. They started doing it early. If the medical collection has a balance of $500 or less, they are actually also removing those from the credit report. So if you have a balance of $499, it should not be there. 501 or it will be there. So if you have something that is less than $500 and it's still reporting on your credit, that is a good account for us to work on for you. Also, it used to be they would have to only wait 6 months before they can report a medical collection on your credit report. They extended that time to 12 months just to give the consumer more time to set up a payment arrangement or just even be notified of the medical collections. So it gave everybody a little bit more time to hopefully have it not hit their credit. Experian Boost is another big thing. I ask people if that does any good. Experian Boost pulls from our FICO 8 model, which again, I told you that and has nothing to do with a mortgage score. So if you're looking to boost your Experian mortgage score, this is not going to help you. It is not used in the calculating mortgage loans. The downside of this also is you have to grant Experian access to your bank account. Essentially, they're going in and scrubbing your account for payments that you make on utilities, your phones, and adding those onto your credit history to boost your score. Again, it's only boosting your FICO 8 model, which maybe some credit cards might use. So really, it's not doing much. And then if you end up paying something late, they just end up moving it as well. So for me, I don't think it's worth the money. Earlier in the slides, or in the presentation, I mentioned, when do we actually recommend settling accounts? So this comes from the perspective of improving your score, not necessarily have something that Mark would recommend as far as getting qualified for a mortgage. But when we're talking about trying to improve your score, here's typically what we recommend. If the collection is within the past 4 years, we typically recommend settling it. And I say that because in California, there's a statute of limitation of 4 years that a creditor can sue you for the debt. So, maybe your lender says you don't have to take care of it, but the last thing we want is to have you then served with legal paperwork, especially if it's like a higher balance account. So normally if it's within the past 4 years, we're going to recommend you settling it. We also always recommend settling utility accounts like AT&T, Comcast. They are notorious for being with a collection agency and then rotating to another collection agency a month later. So you might think something falls off your credit report. You're like, oh, that AT&T collection is no longer there. Well, it's going to probably pop back up because all they're doing is AT&T is assigning it to somebody else. So the last thing you want to be is in a closing and having a new collection pop up. Charge-off accounts in our world, we usually recommend settling those. They normally, for me, when I reach out to the banks, they settle at 50% or so of the balance. Accounts that I'm able to typically negotiate a deletion. So usually that's either a reduction in balance along with them deleting it off the credit report or exchanging payment in full for them to remove it. And the kind of accounts that typically do that, your medical, your utility, when the account has been bought by a debt buyer, rentals and leases, payday advances. And we always just say, be careful if you're talking to a collector on the phone. They will use that information against you. I worked for a collection agency for 10 years and we use everything somebody said on the phone, notated it. So you always want to be very careful on what kind of information you divulge, like where you're working, when you're getting paid, who you bank with. So, speak with a professional if you do have accounts that are in collections. I mentioned earlier about the opt-out pre-screen. So this is if you guys no longer want to get bombarded with all those promotional offers. This also is going to help you when Mark goes and runs your credit and hopefully gets you approved for a loan. So what happens is under the Fair Credit Reporting Act, when somebody pulls your credit, they actually take your information and sell it to other companies. And those companies are then allowed to contact you and make offers of credit to you. So I've seen it where someone had their credit pulled and within that same day had 100 calls from different lenders. And not only is it annoying, it's confusing of, who am I actually working with? It's a super easy process. Go to optoutprescreen.com. Takes about 2 to 3 minutes. It does take about 5 days to go into effect. So if you think you're going to be working with a lender in the near future, I just always recommend go to opt out pre-screen, and then you always can opt back in if you want.
So a couple quick things on that, and we've got some questions.
Okay.
So for me, I can do a soft 3-bureau pool, get all your credit scores, do the pre-approval so that you don't have to get hit with what's called trigger leads. And then once you are actually in contract and go into underwriting, then we would need to run a pool. Would need to pull a hard credit report at that time. And I bring that up because for most people, the issue is timing, right? That opt out that you're talking about, you're going to have to do that at least 5 days in advance. And most people just aren't there. So as a lender, I can do that initially, then, go ahead and do your opt out. We'll run your full hard credit pool and et cetera. So there's that. Question we have is, what's the name of the website where we can check our credit annually for free?
So that one I put it in there. That's going to be annualcreditreport.com. And that's the one through 2023. You can actually check it weekly. And then after 2023, you get one free one a year.
So annualcreditreport.com. I will type that in the chat. And then the next question is, just to confirm, do medical bill collections impact mortgage approval chances? So in many cases, if it's a government loan, we will ignore the medical collection. It may be impacting your score. So that's why you're going to need to talk with your lender and have them look at your credit to determine, okay, do we have score issues? If we got score issues, then we may want to get with Blue Water Credit and resolve that so we can accomplish our goal. If it's a non-score issue, then in many cases we can say, okay, that's fine. We'll leave that alone and we'll move on forward. If it's a conventional product, it's going to be, what I want to say, kind of the same, but it's a little more touchy. It's a little more strict, and sometimes they'll come back and still want it resolved.
Thanks. So where does Blue Water Credit actually come into play then? For you guys out there, our services include credit repair, which really is encompassing trying to remove or update negative items on your credit report into a positive status or have them completely removed. If you need debt negotiations, that's my specialty. So if you are just wanting to negotiate charged off debt, maybe you're not even necessarily worried about your score, but you're just trying to get the best deal possible and you want to resolve the debt, so we can do debt negotiations. We do have some clients that do both debt negotiations and credit repair at the same time, because sometimes they do go hand in hand. And then we also have what I mentioned earlier, consumer advocate services. So recently we got to partner with an attorney's office, and they are taking on our clients at no extra charge. And what they are helping our clients with are inaccurate information that's being reported, misreporting on accounts, ID theft, credit cards that have anywhere from 30 to 90-day late payments in the past 12 months. And what I've said before is what they've been able to accomplish for our clients is getting cash awards back, the debt waived, deleted from the credit. In the case of identity theft, actually for every item of identity theft that is not removed off the credit report, you can have up to $30,000 in a cash award back to you. So that's huge. We actually have one client that has, I think, a total of 4 items right now that they are trying to get him $30,000 for each one of those items. So it's huge. They do that again at no extra out-of-pocket cost for our clients. Best clients for credit repair are going to be those with collections, medical collections that are still showing up under 500 or show that paid, identity theft, when you have late payments, if you need debt negotiation, or even have a bankruptcy on your credit report. We've been successful in getting bankruptcies removed from somebody's credit report because those can stay, I believe, for up to 10 years on your credit. And what you get working with us is we work all your negative accounts every month. Industry average that people are in credit repair programs is 13 months. Ours is 4 months. So we are quick. We are trying to make sure we get you back to your lender as quickly as possible. Our credit experts are going to work with you on ways to maximize your credit score while we're working on your disputes. You get a dedicated person in our office. It's not a call center. You have an online portal that tracks all the accounts that we're working with, regular updates on the program. And we just provide ongoing training like what we're on right now. So really big on the education piece there. And on average, most of our clients can see anywhere from a 15 to 20 point increase every month. Although I've had one client, we got one account removed. She had one just medical collections, got it taken off, bumped her score up 80 points. But on average, 15 to 20 points is what you can expect. Average of 40 to 50% of the negative accounts, we usually are able to get removed. Again, industry standard, I believe, is more like 25%. You're going to see results every 1 to 35 days. So it is a process. So we say, the sooner you can start, the better. The last thing you want is, oh, I'm ready to buy a home, but your credit is not good enough and you're putting in an offer. It does take time. The bureaus have to take time to review our disputes and get back to us. And again, usually take up to 6 months, but on average, about 4 months. I don't know if you want to bring it home or I can bring it home here with.
Well, there's a lot of information. I
know.
hope you folks got a lot of good value out of this webinar. If you did, please give us a type in the chat a yes. I really hope you did. Some additional, if you'd like a copy of an ebook on how to boost your credit by 30 points in 30 days, please email Sarah at bluewatercredit.com and put in there free ebook, please. If you'd like a copy of today's presentation, please send me an email at mark.teran@apmortgage.com. I'll put both of those in the chat and just say, hey, presentation, and I'll make sure you get a copy of this presentation. And then, of course, for a free consultation with Blue Water Credit, send Sarah an email at sarah@bluewatercredit.com within 24 hours, or actually, let's say by the end of Monday, June 19th, and just say, hey, like a free consultation. We're here to help you. Sarah, if you wouldn't mind, type in the chat those 2 email addresses that I gave out.
Let's see. I think it doesn't just let me. It only lets me answer the questions here.
I'm sorry, put it in the chat.
Will they be able to see it there?
Yes.
Okay, there.
And
Hope
then
you guys can see it.
Additionally, if you came through my marketing efforts, expect an email from me. So you're going to get an email from mark.teran@apmortgage.com. And I'm going to let you know that, hey, one of the things I'm going to offer is I'll work alongside you with Blue Water Credit Repair if you decide to work with them, because sometimes it's helpful to have a liaison. I understand the language and the lingo, and they work during the day. Most of my customers are working during the day. So I found over the years that to have me there help translate. I often talk to people in the evening, so I can help bridge that gap for you. So that's the first thing. And then the second is I will offer you an additional discount on your future home loan. So to get that, you need to respond to my email by the end of Monday, June 19th. And, just say, yeah, Mark, I want to take you up on your offer and I'll help you out. So I hope this has been very beneficial for your folks.
Yeah, and Mark, I also mentioned in there, if you guys want those credit builder tools I talked about, the secured credit card or that credit builder loan, feel free to email me and I can get you those links as well to if you want to utilize those things as well as the ebook. And if you're interested in one of our risk-free consultations, we'll work with you on either pulling your credit or if you have a copy of your credit report already from your lender that we can take a look at.
Yep, I'm typing a response. Yeah, so unless you have any other questions.
And Mark, I didn't have your email in there. I don't know if you want to throw that in there.
Yeah, I just sent it on the chat or on the Q&A, okay. But I'm going to put it in the chat as well. mark.teran@apmortgage.com. Reach out to us. We're here to help you. Thank you so much for coming tonight. And bye-bye.
All right. Have a good one, guys.